I tend to look for energy companies where it's not two or three big decisions that are driving it. You don't want to have someone, with a $150 million floating in, 10,000 feet of water and then 5,000 feet of Earth's crust, sub-salt Brazilian. I mean, that's a big chunk of money to write. Best done by some national or partially national oil company. What you want is companies that are making lots of decisions. And the reason that you want them to be making lots of decisions is, as decisions reveal information, they can change how they're making those decisions. And if they are the kind of management that you want to be partners with, they'll make those decisions and change those decisions intelligently. The other thing that you want is you want a long track record. You want a track record of someone who's made those decisions intelligently over time, as demonstrated not by well logs or squiggly lines on a graph or maps, showing what could or could not happen if this, that, or the other well was drilled or mine was mined. You want to see cash went in and cash came out at attractive rates of return for a long period of time. And once you have that, you've already eliminated many, many energy companies. There's an awful lot of promotion in the sector, lots of maps, and if this happens, that will happen. If you eliminate that, you can find yourself with opportunities to buy cash flow producing assets that are mispriced because people are more focused on potential regulation, or they're more focused on gas being at $2 when it's pretty clear only some producers can make gas work at $2. I mean, you can use the swings of the commodity price and the swings of political fortune to find moments when really good businesses run by people with good track records are mispriced relative to their likely cash flows. That certainly is the case of some coal miners today. It's gotten a little bit harder to identify natural gas and oil producers simply because the technology has changed so dramatically. I think we're all waiting to see what the decline curves really are, what the economics of these different basins really are. They're becoming clearer now, but it's very rare to open up an oil and gas presentation and not see a claim of 50 to 100% IRRs on all their new wells, and yet the returns on equity for the industry as a whole are nowhere near that. Or you could argue that some significant percentage of the industry is destroying capital. We have a study here that shows that the finding cost per barrel of Exxon is north of $50 a barrel over the last 3 years, which is a stunning number. Exxon is one of the most respected companies in the world, probably the most competent large energy company out there, and that it costs them $50 a barrel equivalent to add proved developed reserves. It's very difficult to make money adding reserves at 50 and selling for 90. It just, between the time value of money and the cost of lifting the hydrocarbon up out of the ground, you're just not going to make money. And this is Exxon.